Welcome to this explainer. I'm a natural gas trading and risk management consultant from Durga Analytics, and I've spent decades trading physical and financial gas across both European and North American markets. Over the years, I've built and run trading desks, designed ETRM systems, and taught professionals exactly like you how to survive and thrive in this incredibly complex industry. Today, we're going to dive right into the stark, everyday operational realities of running a modern gas trading desk. Now, this is just the beginning of a massive sequence journey. The Natural Gas Trading Desk Master Program spans 9 core modules and 120 chapters. We cover everything from market structure and curve construction to risk, execution, ETRM systems, and ultimately desk leadership and legacy. Every single module is built around real markets, real numbers, and verified arithmetic. But today, we're laying the groundwork with Module 1, Chapter 1, What a Gas Desk is Accountable for. For today's agenda, we have 4 main topics. First, defining a gas desk. Second, the 3 accountabilities. Third, the physics of gas. And finally, real-world case studies from the US and Europe. Section 1. Defining a gas desk. Let's strip away the multi-monitor trading screens, the fancy software, and all the industry jargon for a second. If we boil it down to first principles, what actually is a gas desk? Well, it's essentially a small group of people permitted to enter into commitments about gas that the company doesn't yet have, at prices that aren't yet known, for delivery at times that haven't yet arrived. You see, gas trading isn't simply flipping a coin on whether a price goes up or down. It's the active daily management of massive financial and physical commitments built on stacked uncertainties. And I really mean stacked. Every commitment you make on a desk stacks 3 distinct uncertainties on top of each other. First, you've got volume uncertainty. You're committing to deliver or receive gas, but those quantities depend heavily on the weather, plant availability, or how much your customers actually end up burning that day. Second, there's price uncertainty. Sure, the money changing hands might be fixed by a contract today, but the mark-to-market value of that contract is moving every single second until delivery. And third, time uncertainty. Your obligations are sitting open for days, months, maybe even years. And in that window, literally anything can and will happen. Before we move any further, we absolutely have to talk about units, because confusing energy with volume is a rookie mistake that I see way too often. Gas is bought and sold as energy. In the United States, we trade in US dollars per MMBTU. That's 1 million British thermal units. Over in Europe, it's traded in euros per megawatt hour, or MWH. The fixed conversion rate you need to know is 1 MMBTU equals exactly 0.293071 MWH. A desk that only understands one market's mechanics and ignores the mathematical reality of the other is going to get absolutely destroyed if they try to cross over. Section 2. The 3 accountabilities. So, if you ask a junior trader what their job is, they're almost always going to tell you, making money, right? But if you ask a desk head, that answer is dangerously incomplete. A desk is accountable for 3 things: profit, risk, and reputation. A junior trader might just optimize for P&L, but the desk head is judged on all 3. Generating profit with completely uncontrolled risk just means you got paid for luck, and frankly, your desk is simply waiting for a fatal accident. On top of that, your reputation, how you conduct yourself in the market, is constantly being judged by regulators. A reputation failure can end your career in a single afternoon. You have to balance all 3 of these, all the time. Let's look closely at where the money actually comes from, because this brilliantly illustrates a core truth of our industry. Notice the black bars here representing the share of P&L and the orange bars representing the share of risk capital. Mature professional desks make most of their money from structural relationships, things like locational spreads and storage optionality. Flat price directional betting, which is basically just guessing if the market is going up or down, burns massive amounts of your risk capital for very minimal return. Structure, not direction, is where a professional gas desk actually earns its keep.
Section 3. The Physics of Gas.
You have to remember, gas is not a paper financial asset like a stock. It occupies real physical volume, it moves through highly constrained pipes at finite speeds, and it has a wildly nonlinear demand response driven entirely by the temperature outside. The best example of this physical reality is something called the storage ratchet. A storage facility doesn't just deliver gas at a constant linear rate. As the inventory falls, the physical pressure driving that gas out falls too, meaning your maximum withdrawal rate drops. Imagine selling a 40,000 MMBTU per day winter supply contract. You think you're perfectly matched against a 40,000 nameplate withdrawal limit. But by February, when your inventory drops to 25%, the ratchet effect might suddenly slash your deliverability to 20,000 MMBTU. You are brutally short into the coldest, most expensive market of the entire year, exactly when spot prices are completely unbounded. Section 4. Case Studies. U.S. versus Europe. Now let's step off the whiteboard for a minute and look at how ignoring these fundamental principles actually destroys real-world desks. We always teach both the North American and European examples because these two markets fail in entirely different ways. And as professionals, we ground our autopsies in verified reality. Everything we're about to discuss is drawn strictly from public regulatory records, reports from FERC and NERC in the US, and ACER in Europe. This matrix compares two massive historical catastrophes. In the US, we had Winter Storm Uri in 2021, which was an acute, days-long physical constraint driven by extreme weather. Europe, on the other hand, faced the 2021 to 2022 crisis, a sustained multi-quarter liquidity drain. The U.S. failure was fundamentally about locational basis risk. The European failure was about liquidity and margin risk. Both events completely broke desks, but the mechanics of the destruction were basically the exact opposite of each other. Let's look at Winter Storm Uri. During that storm, a lot of U.S. desks honestly believed they were perfectly hedged. They held long financial positions at Henry Hub, which is the U.S. benchmark, but their actual physical obligations were out at regional mid-continent delivery points. When the physical pipes froze and constrained, the price at those regional points decoupled from Henry Hub by orders of magnitude. The benchmark hub moved slightly, but the regional points absolutely skyrocketed to unimaginable levels. That is locational basis risk. It is completely invisible when the markets are calm, but it appears instantly at the moment of physical stress, and it renders your financial benchmark hedges entirely worthless. Conversely, let's look at what happened in Europe. Here, TTF prices spiked toward 300 euros per megawatt hour. Utilities had hedged their physical customer supply by selling forward on the exchanges, and mathematically, those economic hedges were completely sound. The physical gas they owned gained value at the exact same rate their short exchange positions lost value. But here was the fatal flaw. The exchanges called variation margin in hard cash daily against those exchange losses. The physical gain was just unrealized value on paper, but the margin call demanded cash today. This massive timing mismatch created multi-billion euro liquidity gaps that drained cash reserves and forced huge state bailouts. It turned a mathematically perfect hedge into a fatal liquidity event. Which brings us to the ultimate survival lesson for any professional sitting on a gas desk. You must constantly ask yourself this one question. Are you hedging the economics or are you hedging the cash? Because an economic hedge does absolutely nothing to protect you if it can't physically perform during a freeze or if it drains all of your operational cash reserves through daily margin calls before the delivery date even arrives. So, with the brutal, real-world realities of desk accountability, the physical properties of gas, and market risk now crystal clear, we're ready to advance into Chapter 2, where we'll dismantle the structural differences between physical and financial gas desks. Thank you for joining me for this explainer, but before you go, I want you to think about this. If your desk's limits are breached, but you somehow make a profit, are you a trading genius, or are you just a massive liability waiting to happen? I'll see you in the next chapter. Hey everyone, welcome back to the Natural Gas Trading Desk Master Program. I'm a consultant with Durga Analytics, and over the decades, I've built and run trading desks, designed ETRM systems, and taught teams how to actually survive in both European and North American markets. I'm absolutely thrilled to be your guide for this explainer. Just as a quick reminder, this course covers the whole shebang, from market structure all the way to desk leadership. Today, we're jumping right into Module 1, Chapter 2, Physical versus Financial Gas Desks. Our master program is a sequenced journey across 9 modules and 120 chapters. Right now, we are firmly grounded in Module 1, focusing on the foundational accountabilities of running a gas desk that actually survives and, makes money. Here's our desk-focused agenda for today. We are going to completely dismantle that rookie assumption of physical versus financial trading and replace it with a rigorous, bulletproof understanding of obligation. Section 1. The defining question, rethinking the obligation. Okay, let's get into it. Newcomers to the desk are usually taught a simple rule. A financial trade settles in cash, and a physical trade delivers gas. But honestly, on a real operating desk, that definition is dangerously useless. It describes the settlement mechanism, not your actual obligation. The distinction that truly matters is this defining question. If the market becomes physically constrained on delivery day, does this position require physical actions we simply cannot perform? If the answer is yes, you are holding a physical position, completely regardless of what the confirmation paperwork says. A cash-settled swap at an illiquid regional hub behaves physically under stress. If your risk framework isn't built for that reality, you're flying blind. Section 2. The Obligation Ladder, Mapping Operational Risk. To survive out there, we need to view these trades not as a simple binary choice, but as a spectrum of risk. Think of it as an obligation ladder. It ranges from pure financial swaps on rung 1 all the way to full asset-backed obligations on rung 5. And here's the kicker. Each step up that ladder inherits every single failure mode of the rung before it and adds a brand new, catastrophic way to fail. A desk at rung 1 basically just needs a trader and a clearing relationship. But step up to rung 5? Suddenly you need schedulers, capacity contracts, imbalance monitoring, and a 24-hour rotation. Firms routinely move up and down this commercial ladder without updating their operational framework. And let me tell you, that is a highly reliable predictor of disaster. Because of this difference in obligation, we get 2 completely distinct failure paths. A financial desk fails when the cash runs out before the hedge pays off, right? It's a daily margin game. But a physical desk, it fails when gas literally cannot be delivered or received, and that leads to potentially unbounded replacement costs. You can have the exact same price exposure, but face completely different ways to blow up your book. Section 3. True cost, Europe versus the US. Let's step right onto the desk and look at some real-world math. As a professional, you absolutely must understand the true cost of moving gas in both Europe and North America. In Europe, buying physical gas at TTF and moving it to the German THE hub requires adding capacity bookings, fuel shrinkage, imbalance risk, and credit carry. Your screen price might be $32.80, but your true delivered cost? It's $33.91. This proves that the headline hub spread is never, ever the tradable spread. A trader quoting $32.80 has only quoted the commodity. Every one of those adders is a separate, distinct risk you have to manage. Now contrast that with the U.S. Midwest. U.S. pipelines charge totally differently from European entry-exit systems. Over here, pipeline arithmetic relies on a firm reservation charge, a usage charge, fuel taken in kind, and locational basis. So your commodity is $3.55 at Henry Hub, but your actual delivered cost is $4.28. So, what does this all mean when we put them side by side? Well, look at the normalized comparison. In Europe, the friction is regulatory and contractual, resulting in about a 3.4% delivery premium. But in the US, the friction is heavily locational, creating a massive 20.6% premium. A desk that simply transplants its European cost model onto a US book is going to drastically understate costs. They will win trades they should absolutely be losing. Section 4. Applied Build. Normalizing books.
Let's shift from theory to some hands-on ETRM practice. If you want a job in gas trading or risk, you have to be able to build and defend a position normalization table for a mixed, multi-currency book. Imagine you have a raw book holding positions across Europe and the US. It's a mess of euros per megawatt hour, British pence per therm, and US dollars per MMBTU. Management calls up and wants to know our net exposure. Well, you can't just add these up. Without normalization, that question is literally unanswerable.
So you normalize everything to US dollars and MMB2 to get a net figure. But fair warning, aggregating European length with US length implies a physical hedge that absolutely does not exist in reality. These are different commodities sitting on different continents. Netting them together into a single number is dangerously misleading. The correct deliverable is a normalized table, cleanly segmented by market and by obligation type.
The absolutely crucial point in building this is avoiding the death trap conversion error. An MMBTU is a larger unit of energy than a megawatt hour, so converting price means multiplying by roughly 0.29, but converting volume means multiplying by roughly 3.41. These are reciprocals. If you apply the wrong conversion reciprocal, you will invert the answer by a massive factor of 11.6, instantly destroying your book's valuation. No pressure, right?
To ensure your desk's survival, your ETRM build must pass some very specific structural invariance tests. For example, if you shock the euro to dollar exchange rate by 5% and your US positions move, your currency mapping is broken. Furthermore, computing your notional value in native units versus normalized units must result in an exact match after FX. That is how you immediately catch that 11.6 inversion error before it does any damage. Section 5. Case Studies in Failure. We're going to close out by looking at two devastating real-world case studies where the control framework totally mismatched the actual obligation rung the desk was standing on. First, our European case study. This is drawn straight from the public record of European utilities during the 2021 to 2022 crisis, very notably resembling the German government stabilization of Uniper. A supply entity was structurally short physical gas, while a separate trading entity was long financial hedges. Economically, the overall group was flat. But when prices spiked, the physical assets gained value over years, while the financial short hedges triggered immediate massive margin calls. The desk failed simply because the physical asset and the financial hedge sat in different legal entities, causing a fatal margin squeeze. They were economically hedged, sure, but operationally insolvent. Next up is our US case study. Now, this one is a constructed teaching composite based on public FERC findings from the brutal February 2021 cold weather event. A merchant marketer hedged flat price perfectly with Henry Hub futures and held firm pipeline capacity. But here's the flaw. Firm capacity is a right to move gas, not a right to have gas. When freeze-offs occurred, that capacity was completely useless. The financial hedge paid out perfectly, but the marketer was forced to buy physical replacement gas in a wildly constrained market at $185 per MMBTU. That unbounded physical replacement cost bankrupts the desk entirely, wiping out roughly 475 times the expected margin on the trade. Do you see the stark contrast here? The European market failed on contractual cash timing because of a legal entity mismatch. The US market failed on physical plumbing and real-world deliverability. Both of these desks genuinely thought they were hedged, but their control frameworks were built for entirely the wrong rung on the obligation ladder. So, aligning your risk framework to your true obligation rung is non-negotiable. Think back to that defining question we started with. If you cannot answer yes to having the operational capability when the physical world constraints hit, you are literally trading on borrowed time. If a winter freeze-off hit your primary basin tomorrow, do you actually know which rung of the ladder you're standing on? Take these lessons back to your desk, check your obligation rungs, and build those invariant ETRM tests. Next up, in Chapter 3, we are going to explore asset-backed versus portfolio gas trading. I'll see you there.
Welcome back, professionals. I'm your host, a veteran natural gas trading and risk management consultant from Durga Analytics. You are tuned into the Natural Gas Trading Desk Master Program. This is a sequenced journey across 9 modules and 120 chapters. We go from what a gas desk is strictly accountable for, how European and North American markets are actually built, through your trading playbooks, curve construction, risk and survival, all the way to execution, ETRM systems, regulation, and the legacy of a durable desk. Every single module is built around real markets, real numbers, verified arithmetic, and 20 desk-ready applied builds. Today, we're definitely not dealing in academic theory. We are dealing in P&L, desk survival, and the cold, hard arithmetic of the market as we dive into Module 1, Chapter 3, Asset-Backed versus Portfolio Gas Trading.
Okay, let's dive into this masterclass structure. We're going to cover our program roadmap, the actual shape of your return, the 4 layers of value, compare European and US storage math, build an intrinsic calculator together, and finally, do some autopsies on real-world desk failures.
Starting briefly with the Master Program Roadmap.
Just to ground us all, remember that we're building directly on the obligation ladder we covered in Chapter 2. Let's remind all the desk analysts and traders watching. At rung 5 of that ladder, delivery depends on the physical plant that your desk itself actually has to operate. We aren't just pushing paper or financial contracts around anymore. Delivered cost means the commodity plus capacity plus fuel plus imbalance plus credit. Your asset's value is strictly relative to that benchmark and nothing else. That brings us to Section 2, the shape of return.
And this brilliantly illustrates a fundamental paradigm shift. When you move to asset-backed trading, your return profile changes drastically. An asset-backed return, like the one you see mapped out, truncates your downside. It's bounded by the fixed cost of holding the asset, meaning you really only run it when the market spread exceeds that cost. The upside? Well, the upside is wide open. Compare this to a standard positional portfolio book, which is completely symmetric. You gain and lose equally around 0. So assets aren't just massive positions, they are asymmetric options.
And here is the core truth you absolutely must take to senior management. An asset-backed desk is short cash, but long optionality. A positional portfolio desk is flat cash and long or short direction. Because you hold the right, but not the obligation to capture a spread, your desk demands totally different risk systems, entirely different limits, and vastly different ETRM tooling if you want to survive.
Let's move to Section 3, the 4 layers of value.
So, if it's an option, where's the money actually come from? Let's separate the lockable math from the actual skill of your trading desk. Honestly, any dispute between a desk and management almost always comes down to confusing these exact layers. Intrinsic value? That is fully hedgeable today. Anyone with the asset can earn it. Rolling intrinsic requires a disciplined desk to re-hedge as the curve moves. Extrinsic value comes from volatility. You literally cannot lock it in today, and it requires a highly skilled desk to capture. And finally, operational leakage. Let me be perfectly blunt here. This is a cost. It is never a value.
When decomposing storage value, you inevitably hit that operational leakage. This is value destroyed by outages, fuel costs, imbalances, and nomination errors. I am warning the quants and schedulers right now. If your model ignores this leakage, you're reporting a phantom profit to your board that is never, ever going to arrive in your P&L.
Let's transition into Section 4 and put some real-world math to this. Storage math. EU versus US. Because European and North American infrastructure are built differently, they fail in completely different ways. Take a standard European depleted field. It has a high normalized margin, but it's sluggish. You might cycle it once, maybe 1.5 times a year. Your dominant cost there is the capacity fee. Conversely, look at a U.S. salt dome. The native margin per unit looks painfully low, but the velocity is massive. You can cycle that facility 5 to 12 times a year. The dominant costs here are the storage fee and the fuel.
Now, you might look at those numbers and think, wow, the EU facility earns 81% more per unit of energy natively. But don't fall into the trap of looking at intrinsic margin per cycle. Annual value equals margin multiplied by cycles. Because that U.S. salt dome cycles so rapidly, it can be worth drastically more on an annual basis. Margin per cycle is simply the wrong comparison metric. But remember, it's only worth more if your desk can actually handle that intense operational velocity.
Moving right along to Section 5, Building the Intrinsic Calculator. This is the hands-on applied build for the ETRM professionals and quants tuning in. Here is exactly how you build a deliverability-adjusted intrinsic calculator. Step 1. Compute your naive flat intrinsic. Step 2. Simulate the withdrawal path day by day, applying the deliverability ratchet at every single step. Step 3. Report your intrinsic strictly on the volume you can actually deliver. Step 4. Explicitly label the difference as ratchet leakage. And Step 5, the absolute most critical part, test it. Set your ratchet to a constant 100%. If your simulation doesn't match the flat intrinsic exactly, you've got a bug in your code.
So the crucial point is really about what's not in a naive model. As your inventory drops in the winter, the physical pressure of the facility means you literally cannot withdraw gas as fast. Think of it like trying to squeeze those last few drops of water out of a half-frozen sponge. This is the deliverability ratchet. A naive calculation claims value that physically does not exist. Adjusting your models for this ratchet is the single difference between desks that make their budget and desks that miss it every single cold winter.
Let's get to the autopsies. Section 6, Case Studies in Desk Failure.
We're going to examine how ignoring these concepts destroys P&L in the real world. But before we open up the patients, an explicit disclaimer. To maintain professional distance, these cases are teaching composites. They reflect real structural patterns documented in public records by ACR in Europe and FERC and NERC in the US. They don't represent any single identifiable firm.
Now, what's really interesting here is how the failures perfectly mirror the market structures. In our European case, the desk modeled poorly. They hedged 100% of their nameplate volume. When a cold December hit, the ratchet bound them in January, and they couldn't physically withdraw the gas they had pre-sold. They were forced to buy spot gas at absolute peak winter prices to cover a massive shortfall. Now, in our U.S. case, the desk failed operationally. They bought a Rung 5 asset, but tried to run it with Rung 1 infrastructure. A junior trader missed an out-of-hours intraday renomination during a cold snap. Essentially, they bought an option they structurally couldn't exercise.
For the European desk, that modeling error resulted in a net cover loss of €1,465,200. Let me hammer this home. Booking intrinsic profit on undeliverable volume is a massive governance failure, not just a modeling nuance. You are recognizing revenue against a physical capability that simply does not exist.
And across the pond, the operational failure for the U.S. desk resulted in a negative outturn of $2,141,500 on what was a mathematically profitable asset. This proves a very harsh reality. An option you cannot exercise at the exact moment of maximum value is worth exactly zero.
So let's synthesize these harsh survival truths for your desk. You must hedge only the deliverability-adjusted volume. Treat everything else as optionality, not guaranteed P&L. Furthermore, moving down the obligation ladder from paper trading to physical assets means moving your entire organization. Your risk system, your staff rota, your limits, they all have to adapt to the asset's reality. Capturing extrinsic value requires 24/7 operational capability, cycle-aware scheduling, and truly robust ETRM.
Which leaves us with the ultimate test question before any desk acquires an asset. Can we operate it on the worst day of the year? If the answer is no for sure, do not buy the lease. Understanding who gets to make these acquisition decisions in the first place and how a firm controls that authority brings us directly to Chapter 4 on governance and decision rights. I'll see you in the next chapter.
Hey everyone, and welcome back to this explainer for Chapter 4 of our Natural Gas Trading Desk Master Program. I'm drawing on decades of experience as a natural gas trading and risk management consultant here at Durga Analytics to walk you through this. Just as a quick reminder, this master program is a sequence journey across 9 modules in 120 chapters, taking us from what a gas desk is actually accountable for through trading playbooks, curve construction, risk, operations, and all the way to desk leadership. Right now, we are in Module 1, running a gas trading desk. Okay, let's dive right in. Today, we're exploring why relying on implied authority based on seniority is absolutely the fastest way to blow up a gas trading desk. So, here is our roadmap for today's training. We're going to cover the golden rule, the 4 authority verbs, dive into our European and US case studies, and then finish up with an applied build for your own desk. We are basically building a resilient decision rights matrix that can actually survive the brutal operational realities of both European and North American gas markets. You know, on most gas desks, the words senior and junior really just describe compensation and tenure. They absolutely do not by themselves describe who actually makes the call. Desks that run on implied authority, where everyone just kind of assumes the senior trader decides because, well, they're senior, they'll function totally fine for years and then fail catastrophically in a single afternoon. Why? Because implied authority evaporates precisely when it is contested. When millions are on the line and things go south, suddenly everyone assumes someone else was in charge. And that brings us to the absolute golden rule of survival on a trading desk. There must be exactly one decide per decision. The verb decide means you make the call and you own the outcome. Having 2 owners? That isn't shared responsibility. It is literally no responsibility, because each person will just assume the other acted. And having 0 owners is even worse, because the decision simply defaults to whoever happens to be nearest the keyboard when the clock runs out. Now, while decide is strictly singular, there are 3 other supporting verbs we need to look at. You can assign any number of people to consult, meaning they have to be asked before a decision is made and they might disagree, but they cannot block it. You can have any number of people to inform, meaning they're just told after the fact, but veto must be strictly 0 or 1. A veto is a blunt instrument, right? It can block an action, but it cannot instruct an alternative. It could really only be granted where a genuine block right exists, like on physical integrity grounds. Just look at the visual simplicity of a well-designed decision rights matrix here. You've got decision types mapped out on the left, things like limit breaches or halting trading, and roles across the top. Read across any row to test for ambiguity. If you see 2 dark decide cells, or none at all, well, you have just found exactly where your desk's next major incident is going to originate. Every single row has to have exactly 1 decide. No exceptions. All right, Section 3, Europe, Limits, and Paper Authority. Let's move over to our European worked examples so we can really understand how authority transfers under stress during a limit utilization decision. Imagine a European gas book with a €5 million value at risk limit. A trader wants to add a position that's going to consume another €900,000 of VAR. Pre-trade, they're sitting at 83% utilization. Post-trade, they will hit 101%. So the crucial point to take away here is this. Authority must always be based on the 101% post-trade state. If you use pre-trade determination, a trader setting at 83% could essentially authorize their own trade that breaches the limit and then just report it retrospectively. It literally creates a system that authorizes its own breaches. Post-trade determination removes this loophole entirely. In our European composite case study, which is drawn from public regulatory enforcement patterns, we see what I like to call paper authority. On paper, the matrix placed limit breach resolution squarely with the desk head, looked fantastic to the auditors. But in practice, the desk head traveled frequently and was totally unreachable. So the senior trader just stepped in and resolved breaches informally for 8 straight months. When a major breach inevitably occurred and the market moved heavily against them, there was zero verifiable accountability. The matrix didn't match the observed behavior, which meant there was zero decide owners in practice. The whole thing was a liability, not a control. Okay, moving to Section 4, U.S. Nominations and Shared Authority. Let's pivot to the North American market and look at intraday nominations, because the structure fails a bit differently over there due to the completely unforgiving intraday nomination clock. When a supply counterparty confirms short right before the deadline, say 20 minutes before the cycle cuts off, desks face some severe time pressure. Here are the options on the table. Option A, you cut the downstream nomination and face contract damages. Option B, you buy spot gas. Or option C, you accept an imbalance penalty. Honestly, all 3 of these are survivable decisions with known quantifiable costs. But poorly governed desks default to option D, the non-decision. They freeze. Waiting just feels safer than acting without authority, but missing the cycle entirely removes all those other options and is strictly the worst outcome. To actually survive the U.S. market's control lag, you have to pre-authorize a default action. You need to write it down long before the day it's actually needed. For example, if there is no decision by cutoff minus 10 minutes, the scheduler nominates to confirmed supply. That single, simple sentence converts a catastrophic, unbounded non-decision into a known bounded cost. Let's examine a U.S. composite case study that really highlights duplicated authority. Picture a highly profitable cold morning. The spread is jumping to $36. Operations, looking closely at physical constraints, decides to withdraw at 60% to save deliverability for later in the week. Meanwhile, the trading desk assumes 100% withdrawal to capture that massive $36 spread. Well, the weather forecast later in the week turns mild, and that saved deliverability never even needed. Neither party informed the other precisely because both felt fully empowered. They both legitimately believed they owned the decide right for storage withdrawal rates. And this brilliantly illustrates the sheer cost of ambiguity. Because neither party checked with the other during that 36-40 spread spike, 60,000 MMBTU of foregone volume resulted in an opportunity cost of over $2.1 million. That's a massive hit. Both parties actually acted reasonably based on their own mandates, but the failure was entirely structural. It's exactly why traders point fingers when the P&L suddenly drops at the end of the month. The fix for this is purely structural. Trading should hold the singular decide, right? Because withdrawal is ultimately an economic optimization. Operations should hold a veto, exercisable strictly on physical integrity or regulatory grounds. This setup forces any disagreement to surface and escalate in a matter of minutes, rather than lingering unnoticed until the month-end P&L review rolls around. Section 5, build your decision matrix. Now let's apply all of this directly to your desk with a professional build-it-yourself exercise to ensure your governance actually holds up when you're under fire. Granularity is what makes this tool genuinely useful. First, aim for 12 to 20 rows of recurring decisions. Next, assign exactly 1 decide per row. Then run the ambiguity test we talked about. Any row with 0 or 2 decide cells is a fatal defect. Fix it. Crucially, and most desks never do this, add a column for unreachable case defaults for when your primary decision maker is stuck on a flight. Finally, backtest the whole thing against the last 3 incidents on your desk. If the matrix wouldn't have changed the outcome of those incidents, I guarantee it's too coarse. As we compare the 2 case studies side by side, notice the vital structural contrast here. In Europe, they had paper authority resulting in 0 real decide owners in practice. Over in the US, they had duplicated authority resulting in 2 decide owners in practice. But having 0 decision owners and having 2 decision owners fundamentally produce the exact same operational failure. In both scenarios, everyone assumes someone else is managing the risk. So I want to leave you with a provocative thought to test your own desk's reality.
When the authorized decision maker doesn't answer their phone 10 minutes before a rigid U.S. nomination cycle, exactly whose keyboard makes the call on your desk? Is it clearly written down, or are you guys just hoping for the best? Go lock that down. And when you're ready, join me in Chapter 5, where we'll use these exact limit bands we discussed today to define mandates and capital allocation. Keep your risks tightly managed, and I'll see you in the next one.
Welcome to This Explainer. I'm your Darga Analytics consultant, and today we're moving way beyond basic limits to dig into the actual governance mechanisms that keep a physical and financial gas desk alive. Look, whether you're an aspiring quant, a seasoned originator, or an ETRM professional, surviving in this market requires absolute crystal clarity on what a desk is, and just as importantly, isn't allowed to do.
So before we jump into the weeds, let's quickly ground ourselves in the overarching map of our natural gas trading desk master program. This is a sequenced journey across 9 modules and 120 chapters. Right now, we're in Module 1, and we're tackling Chapter 5. This builds directly on the foundation we laid in Chapter 4, and we're zeroing in on how decision rights must operate inside a hard, unforgiving mandate boundary. Here's our agenda for today. We'll cover enforceable desk mandates, detecting mandate drift, building a governance dashboard, the ROC reality check, Europe versus US failures, and finally, our key takeaways.
Okay, Section 1, Enforceable Desk Mandates.
Let's start by defining what a mandate actually is. Simply put, a mandate is the written answer to one question: what is this desk permitted to do? Keep in mind, it's not a strategy document, it's not a target, it is a strict, hard boundary. Now, a useful mandate absolutely must constrain on 4 axes simultaneously. Those are product, tenor, size, and market. Leaving even one of these vague creates an exploitable gap. Take the size axis, for example. Writing down prudent levels is completely unmeasurable. It means nothing. The enforceable version specifies a strict value at risk ceiling, a maximum volume per month, and a percentage cap on average daily volume. You literally have to lock down all 4 axes or you're exposed.
So I want you to ask yourself this critical Socratic question about your own desk right now. Could a compliance officer with zero trading knowledge read your mandate and know instantly if a given trade is allowed? If the answer requires a conversation with the trader to clarify their intent, then your mandate isn't a control. It's just a suggestion.
Moving on to Section 2, Detecting Mandate Drift. Let's talk about how boundaries actually fail in the real world. You see, mandates rarely get broken in dramatic, explosive ways. Instead, they get stretched, one perfectly defensible step at a time. We call this mandate drift. Imagine an 18-month timeline for a desk that's strictly mandated for Northwest European hubs only. Step 1. They execute a trade at an Italian point as a one-off hedge against a Northwest position. Highly defensible, right? Step 2. Well, it worked, so they do another one. Suddenly, it's a small book. Step 3. An Italian counterparty offers a bespoke structured deal. It fits within the overall size limit, so nobody raises an eyebrow. Then, Step 4. 18 months later, the desk is sitting on a material Southern European book that no mandate actually authorized, and frankly, no risk model calibrates for. The scary part? Not a single step in that sequence involved a hard limit breach. This is exactly why limits alone do not catch drift. You absolutely need active composition monitoring, which, shockingly, most desks lack entirely. You really need 3 things in place. First, a new point report that flags any delivery point traded for the first time in 12 months. Second, composition drift tracking to watch the share of risk by market and product on a monthly basis. And third, quarterly mandate reconciliation, where every single position is mapped directly back to a specific mandate clause. If it can't be mapped, it gets authorized formally, or it gets closed, period.
Let's make this actionable. Section 3, Building a Governance Dashboard. We're going to walk through an applied, build-it-yourself exercise to track all this on a real desk. To build a robust dashboard, you're going to need position data, allocated capital,
realized P&L, and a heavily parsed mandate document. The final output should give you a ranked ROAC table, a composition drift chart, and an exception list for any unmappable positions. But here is the ultimate acid test. You have to inject a synthetic position at an unlisted delivery point into your data. If that synthetic trade doesn't immediately show up on your exception list, your mandate parsing is way too loose. Building this kind of system is exactly the governance thinking that separates a true risk analyst from someone who just runs reports.
Which brings us to Section 4, the ROAC reality check.
With our dashboard up and running, we have to transition to the mathematical reality of capital allocation. Why? Because looking at absolute P&L is a terrible metric for desk survival and deciding how to distribute capital. Just look at the stark contrast between capital consumption and return here. U.S. flat price eats up 15% of the desk's capital, but it only delivers 5 points of return. Meanwhile, the LNG arbitrage book consumes that exact same 15% of capital, but generates absolutely massive returns.
That results in a return on allocated capital, or ROAC, of 30.7% for the LNG arbitrage book. Compare that to the U.S. flat price book, which is sitting at just 4.7%. Now, the naive junior conclusion is to immediately rip 10 points of capital away from U.S. flat price and shove it all into LNG arbitrage.
But here's the crucial point. You cannot just linearly scale capital into whatever book has the highest ROAC. You have to interrogate 4 distinct things first. Number 1, capacity constraints. That LNG arb might only actually be available on 3 cargoes a quarter, so doubling the capital might just have your ROAC. Number 2, correlation. If your LNG arb and your EU basis books both rely on the TTF to JKM relationship, you aren't diversified. You're just making a single bet while wearing 2 hats. Number 3, franchise value. That low-return U.S. flat price book might actually be generating the vital market intelligence that the other books rely on to trade. And finally, survivorship in the sample. One incredible year might just be a favorable market regime, not actual trading skill. You have to look deeper.
Let's look at how this plays out in the real world. Section 5, Europe versus U.S. failures.
To really cement these concepts, we're going to examine a tale of 2 markets, because European and North American desks fail in fundamentally different ways. Every professional in this space needs to understand both. Now, before we look at the numbers, please note that both of these case studies are constructed teaching composites. They reflect widespread industry patterns and regulatory commentary. They are not based on specific identifiable firms.
Structurally, these markets demand completely different mandates. In Europe, virtual hubs like TTF and THEA are largely fungible within a market area. But over in the US, failing to explicitly enumerate every specific physical pipeline point invites massive, distinct basis risk. And the regulations differ entirely, too, from REMET inside information handling in Europe to FERC and CFTC conduct orders in the US. Let's see how these structural differences lead to total disaster when governance fails.
Starting with our European case study. Here, a desk held a mandate that permitted Northwest European gas and, quote, related hedging instruments. That incredibly vague phrase was the fatal defect. The desk hedged gas with German power, and then they hedged storage with carbon allowances. The problem? Neither of those was in the risk model's calibration set. So, when the correlation between gas, power, and carbon inevitably broke down, the desk suffered a net loss of over 1.3 million euros on positions that were, on paper, just supposed to be hedges. Because the risk models were completely uncalibrated for power and carbon under a gas mandate, this so-called hedge only captured 19% of the gas loss when the market violently moved. Vague mandate language is not just a minor legal drafting issue. By saying related hedging instruments, they implicitly authorized an entire cross-commodity book. You absolutely must explicitly enumerate your instruments, no exceptions.
Conversely, let's flip over to our U.S. case study. Here, capital was allocated annually based purely on trailing absolute P&L. Because the flat price book had high absolute returns right at the start, it kept getting fed more and more capital.
Over a 3-year period, it consumed an average of $118 million in capital to produce a net loss of $5 million. That's a negative 3.9% ROAC. Meanwhile, the basis book was starved. It got just $28 million, despite actually producing $18.4 million in profit, an astonishing 65.7% ROAC. Allocating based on absolute P&L rewarded the outcome rather than the process, which compounded a fatal concentration error.
And let me tie this back to our earlier lessons. Permitting generic U.S. natural gas without enumerating the exact delivery points is the exact same fatal mandate failure that caused those massive Winter Storm Uri losses we discussed back in Chapter 1. If you do not enumerate the specific points, you implicitly permit trading at illiquid hubs whose basis behavior under extreme stress looks nothing like the benchmark. Enumerate the points, always.
All right, Section 6, Key Takeaways. Let's bring all of this together into the core rules for desk survival. If you want to survive and actually thrive in this space, you must write enforceable 4-axis boundaries. Remember, limits alone are blind to mandate drift. You have to actively monitor for composition drift. You must allocate your capital mathematically through multi-year ROAC rather than emotionally through absolute returns. And finally, whether you are operating in Europe or North America, always explicitly enumerate your permitted instruments and physical delivery points.
Our next chapter is going to build right on top of this by exploring pre-trade vetoes. You see, a mandate only defines the outer boundary of permitted activity. It says absolutely nothing about whether a permitted trade is actually a good idea. Which leaves you with one final question to ponder before next time. Just because your mandate permits a trade, does that automatically mean you should execute it? We will answer exactly that in Chapter 6. Thanks for joining this explainer, and I'll see you in the next one.
Welcome back to the Natural Gas Trading Desk Master Program. I'm your host, a natural gas trading and risk management consultant from Durga Analytics. As a quick reminder, this explainer is part of our sequence journey across 9 modules and 120 chapters. We're covering everything from what a gas desk is accountable for and how European and North American markets are actually built, all the way through trading playbooks, curve construction and valuation, risk and survival, execution, ETRM systems, regulation, and finally, desk leadership and legacy. Each module is built around real markets, real numbers, and desk-ready applied builds. Right now, we're in Module 1, and today we're diving into Chapter 6, When Not to Trade Gas. We're going to explore what is absolutely the hardest discipline on any gas trading desk, which is knowing exactly when to stand down.
So let's get into it. Traders are selected, trained, and paid to take positions, right? The institutional pressure on a desk runs entirely one way: do a deal. But we need to fundamentally shift your desk's mindset here. We've got to realize that choosing cash over a bad risk-adjusted return is an active, deliberate position. Look, stated as doing nothing, not trading, sounds like a character flaw. But if you frame it as a calculated decision that the available return is worse than just holding cash, well, that suddenly becomes a strict quantitative comparison. And comparisons are exactly what your trading desk is built to execute.
Building on our previous sessions in this module, I want you to remember something crucial. A mandate merely permits a trade. It doesn't magically make it a good one. You should really think of a mandate as a guardrail, not a GPS recommendation telling you where to go. Just because something is permitted doesn't mean it's advisable. Plus, optionality only actually has value if your desk operations can physically exercise it in the real world. As you'll see, the further down the operational ladder you sit, the more ways a technically permitted trade can completely blow up on you. Here is our roadmap for today. We'll cover the pre-trade veto sequence, European rule-dependent trades, U.S. liquidity drop sizing, some real-world case studies, and finally, the ETRM veto build.
Okay, Section 1, the pre-trade veto sequence. Let's arm you with the core defensive framework every durable desk needs.
What you're looking at is the 5-step pre-trade veto sequence. This is designed to catch fatal flaws before you ever execute. Number 1, information asymmetry. Are we trading against a counterparty who simply knows more than us? 2, exit costs. Can we get out of this position in one day at a known cost? 3, rule dependency. Does our profit completely rely on a regulation staying unchanged? 4, sizing. Is the size just a guess, or would we still hold this if it were 3 times as large? And 5, operational capability. Can our scheduling team actually physically perform if this goes to delivery?
Now, what is absolutely critical to understand here is that this sequence is strictly a veto system. It's not a scorecard. A single no on literally any of these 5 means you stand down immediately. We do not weight these. Why? Because weighting invites a trader to offset a hard no with a few soft yeses. And that's exactly like saying, well, the brakes on this car don't work, but the radio sounds fantastic, so let's go for a drive. That is exactly how risks checklists fail on gas desks.
Moving right along to Section 2, European Rule Dependent Trades. Let's see how this works in practice. Let's look at a European worked example. Imagine your desk is offered a structured deal at a European hub. The volume is 180,000 megawatt hours, but the economics heavily depend on a capacity tariff structure that is currently sitting under regulatory consultation. Under the current tariff, you model a solid 1.85 euro margin, giving you a 333,000 euro expected value. Great, right? But wait, if the proposed tariff actually goes through, that margin flips to a negative 95 cents, resulting in a 171,000 euro loss. That single tiny rule change creates a massive €500,000 swing on your P&L. Now, let's say your quants are brilliant, and they rigorously assess that there's only a 25% chance of that rule change actually occurring. That means the expected value remains mathematically positive at 207,000 euros. So, here is the million-dollar question. If the math says yes, why must your desk still walk away? You walk away because a rule dependency is by definition an unhedgeable short option. Real risk management fundamentally relies on your ability to adjust a position after entry. If that consultation suddenly moves against you, there is no instrument anywhere on the curve you can trade to hedge a tariff consultation. And your counterparty certainly isn't going to unwind it out of the goodness of their heart. An unmanageable position is just a gamble, plain and simple. It's not a trade. It has to be declined or strictly isolated against a specific sublimit. You never, ever book it as ordinary structured margin. Let's cross the Atlantic now for Section 3, U.S. liquidity trap sizing, to examine the exit cost veto. Suppose your desk identifies a really attractive basis relationship at a U.S. regional point. Your analysis is flawless, but it trips the exit cost veto. Let's run the math on a 420,000 MMBTU position. To exit safely without moving the market against yourself, you can only realistically participate in roughly 25% of the average daily volume, or ADV. At the highly liquid Henry Hub benchmark, no problem. You can get out safely in 1.4 days. But at this thin regional point, which has a fraction of the volume, you are trapped in that position for over 5 days. And if you are forced to exit over those 5+ days at that thin point, the market is absolutely going to sense your desperation. It will move against you. Assuming a highly conservative 28 cents of slippage per unit on a forced exit, that's going to cost your desk a visceral $117,600 just in slippage cost alone. And this brilliantly illustrates our absolute golden rule for this chapter. If slippage consumes nearly half your expected profit on a normal exit and completely wipes it out during a stressed exit, you have to radically reduce the position size to fit a safe 2-day exit window. The correct response isn't to just abandon a sound thesis. The response is size to the exit, not to the conviction. Moving to Section 4, Real-World Case Studies. Let's see the P&L carnage when these vetoes are ignored. We are going to compare failures in both markets side by side.
Just so you know, these are composite case studies drawn directly from actual regulatory findings and market monitoring data. In both scenarios, the desks had valid mandates and mathematically sound theses, but they both completely failed critical vetoes. The European desk failed the exit cost veto and got crushed by evaporated liquidity, while the US desk ignored their lack of operational capability. Let's break down exactly how each desk blew up. Let's start with Europe. The desk built a position at a peripheral hub based on a totally sound convergence thesis, but they sized it purely on their own conviction at 2.5 times the normal ADV. Then the inevitable happened. Market stress hit. And as we know, liquidity at peripheral points reliably evaporates first. The normal ADV collapsed by over 70%. Suddenly, without this desk trading a single additional lot, their position became a fatal 8.6 times stressed ADV trap. They were forced to exit into an absolute void at a massive loss. It proves a really harsh reality in gas trading. Being right but insolvent is indistinguishable from just being wrong. Over in the US case, the failure was purely operational. An attractive physical supply arrangement passed the first 4 vetoes, but it failed the 5th. The desk had no overnight scheduler rostered. The trader went ahead and booked it anyway for an expected $84,000 margin. Well, a severe cold event materialized, and a mandatory intraday renomination was required at 2 a.m., but nobody was awake to submit it. The resulting pipeline penalties, imbalances, and replacement gas costs triggered a staggering $526,400 net loss. The lesson here is absolute, folks. Unusually good margins in gas are almost always just payment for a risk that somebody else, who was either better informed or better equipped, declined to take. 4 passing vetoes cannot magically offset the one operational veto that failed. The sequence is a hard defensive perimeter. Permission in a mandate is just permission. It is absolutely not trading advice. Finally, Section 5, the ETRM veto build. Let's translate this theory straight into your desk's technology. To prevent these exact failures, your energy trading and risk management system, your ETRM, should be doing the heavy lifting here. Here is your build-it-yourself ETRM integration. Build a screen that takes the proposed position size, the points ADV, and the assumed slippage. The system must automatically compute the days to exit based on a safe 25% participation rate and immediately output a hard size limit capped at 2 days. Finally, you build those 5 vetoes in as explicit Boolean checks. If a trader overrides a veto, you force a mandatory free text justification. Why does this test matter so much? Because that override log becomes an incredibly invaluable, auditable data set for desk leadership to see exactly where risk limits are being stretched on the floor. As we wrap up this explainer and look back at everything we've covered, from the unhedgeable rule dependencies in Europe to those brutal liquidity traps in the US, the core theme of this chapter is brutal honesty about your desk's operational limitations. Sizing your positions based on comfort or just blindly using the theoretical maximum of your mandate is a luxury that natural gas markets will eventually and severely punish. That concludes Chapter 6. But before we part ways, I want to leave you with a final provocative thought to take to your desk tomorrow morning. If your desk experienced a severe market shock tonight, which of your quote-unquote safe positions are currently sized to completely trap you by morning? Are you sizing by comfort or by the unforgiving arithmetic of stressed risk? Think about it. In our next explainer, Chapter 7, we're going to build directly on this by distinguishing speculative points from flow control points and pinpointing exactly where your controls must be dense after execution. Until then, manage your risk, respect the vetoes, and trade well. Hey everyone, and welcome back to the Natural Gas Trading Desk Master Program. We're continuing our sequenced journey across 9 modules and 120 chapters, covering everything from market structure and physical pipelines right through to valuation, risk, ETRM systems, and desk leadership. As always, I'm your host, a veteran gas trading and risk management consultant from Durga Analytics. This explainer is your deep dive into Module 1, Chapter 7, Speculative versus Flow Control Points. If you're an aspiring or working gas trader, originator, quant, risk manager, or ETRM professional, what we're going to cover today is absolutely going to fundamentally change how you view desk survival. Let's get into it. So, just to set the stage, remember what we covered back in Chapter 6. We walked through the pre-trade veto sequence. And look, that sequence is fantastic for a very specific type of trading. But today, you're going to see exactly why that same sequence does almost nothing for a flow desk. We are shifting our focus strictly to practical desk operations and how to profile your controls properly so your desk actually survives in the real world. Here is our roadmap for today. We'll be hitting 5 key sections: 2 businesses sharing a room, the thin margin math, a European case study on the wrong profile, a U.S. case study on unowned residuals, and finally, fixing the mixed desk. Okay, starting off with Section 1, 2 businesses sharing a room. Listen, a mixed gas desk is basically 2 fundamentally different businesses that are just forced to share the same operational room. Now, speculative desks require the absolute heaviest control density pre-trade. You need a mandate, a veto sequence, and a strict limit check before the decision is even made. But flow desks, they're a completely different beast. They require control density heavily post-trade, at the points of capture, position refresh, and settlement. Let's break down exactly why their profiles are total opposites. A speculative return comes from being right about a direction or a spread view. A flow return, on the other hand, comes from the margin on intermediated volume, which is typically, 10 to 20 times higher than speculative volume. In a speculative book, positions are held deliberately, but in a flow book, they appear incidentally, kind of just left over as residuals. Because of this, your main risks are totally different. If you fail in speculation, it's a huge loss on a known position, because your view was just flat out wrong. But if you fail in flow, it's death by 1,000 cuts. It's many small losses on positions nobody even examined, driven by operational error at scale. So, applying a speculative control profile to a flow book leaves this massive, incredibly dangerous gap. Which brings us to Section 2, the thin margin math. Imagine you've got a desk reporting 2 books. The speculative book trades 180,000 MMBTU and makes $8.56 per unit. Meanwhile, the flow book trades 2.4 million MMBTU and makes just 0.371 per unit. Now, a naive reading of the P&L per unit might make you think, wow, the speculative book is 21.7 times better. But actually, that ignores the capital at risk, the variance, and the immense franchise value of the market information that the flow book naturally generates. High unit margin is simply compensation for variance, not evidence of a superior business. We really have to look at risk-adjusted capital here. Because flow margins are so incredibly thin by design, a tiny capture error, say just 2 cents per MMBTU, has a drastically different impact depending on the book. On the speculative book, that error costs you $3,600, or a mere 0.25% of your P&L. No big deal, right? But on the flow book, because of the massive volume, that exact same 2-cent error cost $48,000. That destroys 5.4% of the entire book's P&L. Thin margin businesses are destroyed by small, systematic errors, not large, obvious mistakes. And this is exactly why a flow desk's control density has to shift heavily to the right, deep into the post-trade lifecycle. Moving on to Section 3, Europe case study, the wrong profile. Let's track a 9-month chronological failure through a composite case study. We're looking at a desk intermediating at European hubs like TTF and THE. In month 1, they inherit the speculative pre-trade approval process. Well, by month 2, this heavy pre-trade approval makes flow intermediation so unbelievably slow that it's uncompetitive. So what do the traders actually do? They start splitting flow trades below the approval threshold, literally just to get the business done. Over the next few months, post-trade controls remain light because, hey, the speculative book never really needed them.
Deal capture starts to drift, relying heavily on just trader memory at the end of the day. By month 9, management finally discovers a systematic capture error of just 0.035 euros per megawatt hour. And I want to be absolutely clear on this. The trader splitting those tickets, that was not a conduct issue or a breach. It was a workaround that signaled a massive control design failure. Let's hit the verified arithmetic on that European composite. Over those 9 months, the flow volume was 4.1 million megawatt hours. That tiny, basically undetectable 0.035 euro error, it resulted in 143,500 euros in sheer revenue leakage. Out of a flow margin of 1.27 million, that tiny error silently destroyed 11.3% of the desk's entire margin. Poof, gone.
This brings us to a vital diagnostic lesson. When traders systematically work around a control, the control is wrong for the business, not the traders. Notice how no single error exceeded any threshold here? The speculative book was perfectly controlled throughout this entire 9-month period. Competence in speculative control provides absolutely zero protection for flow operations. The fix for this desk is to remove that pre-trade threshold for flow entirely and instead introduce automated execution time price capture with an independent reasonability check. All right, Section 4, U.S. Case Study, Unowned Residual Positions.
Now, what's really interesting is when we cross the Atlantic, we see the North American market fail in a completely different way, all because of its unique physical plumbing. In Europe, entry-exit systems abstract a lot of the transport risk. But the U.S. plumbing requires 2 extra highly critical post-trade controls for a flow desk. First, capacity utilization reconciliation. In the U.S., firm transport is paid for whether you use it or not. If you reserve capacity and underutilize it, your effective unit transport cost skyrockets, and it'll eat your thin margin alive. Second, operational flow orders, or OFOs. Pipelines issue these to restrict imbalance tolerances at really short notice. If a U.S. flow desk misses an OFO, the sudden penalties will absolutely dwarf their entire margin. Check out this composite U.S. mixed desk failure. Flow intermediation often leaves imperfect matches between buy and sell legs. In month 1, these are tiny, individually trivial residuals. We're talking under 5,000 MMBTU a day. By month 2, literally nobody is watching this because the flow book is assumed to be flat by construction, so it has no directional limits. By month 3, these residuals quietly accumulate at 2 regional points. Then, bam, in month 4, the book is suddenly 265,000 MMBTU net long, right when a regional basis moves $1.85 against the desk. These individually trivial residuals accumulated into a lethal, unowned position simply because no process was designed to sweep them. The consequence here is absolutely brutal. That 185 basis move on a 265,000 MMBTU position creates a loss of over $490,000. Against an annual flow margin of $890,000, that is 55.1% of the year's flow margin wiped out in a single move. And the crazy part, it was lost on a position that no mandate authorized, no trader actively chose, and no limit constrained. This brilliantly illustrates a core law of risk management. Descriptions are not controls. Just because a book is described internally as being flat by construction, that doesn't excuse the desk from actively controlling for directional drift. This is exactly what we discussed back in Chapter 4 as a zero-to-side owner failure, except here it's showing up as an accumulated position rather than a single bad trade decision. Which leaves us to our final part, Section 5, Fixing the Mixed Desk. So, how do we actually fix the room and keep the desk surviving? Here is your organizing principle. Step 1, separate the books explicitly. Seriously, stop treating them as the same business. Step 2, apply the correct control profile to each. Speculative gets the heavy pre-trade controls, flow gets the heavy post-trade controls. Step 3, you absolutely must implement a daily residual sweep with a stated volume threshold. And finally, step 4, Any excess residuals above that threshold must either be flattened immediately or they need to be explicitly transferred into the speculative book, carrying the full pre-trade authorization that implies. The golden rule: residual positions from flow activity must never, ever be allowed to just sit there unowned.
Let's move to our applied build, something you can actually take back to your desk tomorrow. I want you to create a control point coverage map. List the 6 stages of the trade lifecycle: pre-trade, execution, capture, position, scheduling, and settlement. Map the controls that actually run on your desk day to day, not just the fantasy written in some policy document somewhere. Then compute the expected annual cost of a one-tick systematic error, like a 0.01 unit error, for each book. If the flow books figure isn't materially larger than the spec books, you need to check your volumes again. Computing the exact cost of a one-tick error converts abstract risk into a hard, undeniable dollar number that management will actually respond to.
We've spent this explainer seeing how bad control design slowly leaks margin and wipes out P&L. But what happens when the entire framework just collapses? Think about this. If small errors can do this much damage, what happens when multiple structural defects align at the exact same time? That provocative thought brings us right to Chapter 8, where we are going to assemble all the components we've learned so far, from mandates and veto sequences to control densities, to examine catastrophic multi-defect desk failures. It's going to be a big one, and I'll see you in the next explainer. Hey everyone, and welcome to today's explainer for Chapter 8 of our master program. Today, we're shifting gears. We've spent a lot of time talking about how to build a desk, and now we're going to dissect exactly how one actually dies. I'm stepping in today with my hat on as a natural gas trading and risk management consultant from Durga Analytics. Over the last couple of decades, I've spent my career trading physical and financial gas across European and North American markets, designing ETRM systems, and teaching traders, quants, and risk managers how to survive in this business. And I can tell you right now, for sure, understanding how trading desks fail is absolutely just as vital as knowing how they make money. As a quick reminder of where we are in this journey, our 120-chapter master program is broken down into 9 modules. Today, we are officially wrapping up Module 1, Running a Gas Trading Desk. You really have to know what a desk is accountable for before you can effectively trade, schedule, or build ETRM systems for it. From here, we'll be moving into market structure, playbooks, valuation, risk, execution, ETRM, regulation, and finally, desk leadership. So we have a really packed agenda today covering 6 key areas. We're going to look at the anatomy of a failure chain, talk about fat tails and broken models, contrast a European case study with a US case study, do a desk-ready build called the incident chain analyzer, and finish up with the invisible prevention paradox. Let's get right into it. Starting with Section 1, the anatomy of a failure chain. Here's our central thesis for today. Catastrophic desk failure is literally never a single event. It is always a sequential chain of broken structural links. When a desk blows up, the natural instinct in the postmortem is to hunt down that one big fatal mistake. But honestly, that's a myth. Look closely at this visual. Notice how the failure maps out, starting way over on the left with a vague mandate, cascading down through incorrect control profiles, ambiguous decision rights, sizing positions to conviction rather than exit liquidity, all the way to a final stress event that triggers the actual loss. Every single catastrophic loss we've covered requires all 6 of these links to hold together. And what that means for us on the desk is that breaking just one link prevents the entire disaster. That is your operational superpower. Moving on to Section 2, Fat Tails and Broken Models. So, if failure requires this whole chain to connect, why don't our standard risk models catch these links before they snap? Quants and risk managers, this is absolutely crucial. Gas prices gap, they do not just drift. This happens because of physical constraints. If a pipeline freezes solid or a storage facility completely empties, you can't just print more physical gas. That creates what we call a fat tail in the probability distribution. It means extreme outcomes happen way more frequently than a standard normal distribution model would ever predict. To figure out how badly a model is failing, you use the exception ratio. You just take your observed exceptions and divide them by your statistically expected exceptions. This chart perfectly illustrates the danger of relying on those standard models. That smooth blue area, that's your model's assumption, a nice, neat, normal distribution. But that jagged red area is the gas desk reality. A value at risk, or VAR, number calibrated on calm everyday periods, perfectly describes the middle of that bell curve, but it totally ignores the left tail, which is literally where trading desks die. Notice that massive red spike on the far left? That is a physical constraint binding in real time. Let's put some real numbers to this to see the impact. Say your model predicts 2.5 exceptions over a year, but you actually hit 9. Your exception ratio is 3.6 times what you expected. So your model is systematically understating how often risk occurs. But the magnitude is the real killer here. When your worst loss hits 4.9 times your 99% VAR, your model isn't just a conservative approximation anymore. It is a totally false sense of security. When it fails by a massive multiple. This is exactly why you have to supplement standard VAR with scenario-based stress testing if you want your desk to survive. Let's see how this plays out in the real world. Section 3, the European case and the definitional defect. We'll apply this to a constructed composite case study for a European desk. In these hub-based markets, failure usually stems from definitional and mandate drift. So this desk advanced through the failure chain starting right at link 1. They had a vague mandate that just said European gas, allowing them to trade unenumerated hubs. As they grew their physical flow business, they mistakenly retained their old, speculative pre-trade controls. They sized their positions strictly to VAR without applying any liquidity constraints. And then, a supply disruption stress event hit. Peripheral hub liquidity evaporated overnight, cross-commodity correlations broke down, and they were completely trapped. The aggregate loss was nearly 1.9 million euros, which was 2.2 times their VAR. And here is the crazy part. It happened without a single individual acting improperly or breaching a limit until that final stress event arrived. Every single step seemed completely defensible in isolation. But if they had just implemented a simple monthly composition report, a control that costs effectively 0, they would have broken the chain right at link 1. Now, Section 4, the U.S. case. Let's look at the interrupted chain. You absolutely cannot just copy-paste a European control framework onto a North American book, because these two markets fail in fundamentally different ways. While Europe fails on mandates and virtual hubs, the U.S. market features highly locationally fragmented point-to-point infrastructure. That pushes failure away from mandates and squarely toward operational capability, physical scheduling, and residual sweeps. The dangerous links differ entirely based on the actual physical design of the market. In our U.S. constructed composite case, we can see exactly how automated ETRM controls save desks. An automated new point report flagged a delivery point that hadn't been transacted in 12 months. Because of that flag, the desk asked a crucial operational question: do we actually have overnight scheduling cover for this point? The answer was no. Right before a massive cold snap hit, this incredibly simple report successfully interrupted the chain at link 2, whereas our European desk did nothing and let the chain complete. The financial math on this intervention is just incredible. The desk had to pay a $78,000 early exit cost to close out the position. But by doing that, they avoided a $27.2 million replacement cost catastrophe when the cold event actually hit. So this automated control yielded a staggering 349 times return on intervention. That is exactly what risk management paying for itself in real time looks like. All right, Section 5. Let's build something you can use today, the Incident Chain Analyzer. It's time to put all this theory into practice on your own desk. By mapping your last 5 near misses against our 6-link chain, you build your Incident Chain Analyzer. This is how you operationalize theory directly into your ETRM workflows. The test this build must pass It has to point you to the absolute cheapest control investment required to break the chain. Near misses are the richest data you will ever get. Don't waste time trying to fix the most expensive incident. Instead, fix the most frequent weak link with the cheapest available detector you have. Which brings us to our final section, Section 6, the invisible prevention paradox. There's a psychological and cultural catch to everything we've talked about, and it destroys a lot of really good risk managers. The most dangerous question you can ask in a postmortem is, what's the root cause? Because honestly, it usually just ends up blaming the person standing at the last link. Instead, you need to ask, which link was cheapest to break? Think back to that US desk paying $78,000 to exit early. In any month where that cold event did not arrive, paying that exit cost would look like a pure mistake. So you must make sure you track near misses in a prevention register. If you don't make prevention visible, it gets punished and eliminated as an unnecessary expense. And that brings us to the end of Chapter 8. Next time, in Chapter 9, we're going to connect this directly to what happens to authority and decision rates when the market is under extreme stress. I want to leave you with a question to think about for your own desk. When the market goes absolutely haywire tomorrow and your models inevitably break, who actually has the authority to step in, override the system, and stop the bleeding? I'm really looking forward to exploring that with you next time. Welcome back, everyone. I'm your host, a trading and risk management consultant from Durga Analytics. And today, we're continuing our explainer of the Natural Gas Trading Desk Master Program. As you know, this program is a massive, sequenced journey spanning 9 modules and 120 chapters. We cover everything from what a gas desk is actually accountable for and how European and North American markets are physically built, all the way through curve construction, execution, ETRM systems, regulation, and finally, desk leadership. Right now, we're firmly planted in Module 1, Chapter 9, which is all about authority, overrides, and escalation. This directly builds on what we discussed in Chapter 4 regarding decide owners and the lessons from Chapter 8 on how failure chains rapidly develop under stress. Today's focus is incredibly practical. We are looking at the desk-focused tools you need to protect capital and guarantee operational continuity. So let's jump right in. We've got a tightly packed agenda today. We'll start with what I call the escalation illusion, then look at triggers and delay costs, governing system overrides, and compare the specific escalation mechanics of the EU versus the US. Finally, we'll look at some composite case studies and wrap up by building your very own trigger register. Okay, Section 1, the escalation illusion. Let's get straight to the core of a massive vulnerability hiding on most gas desks today. Most trading desks mistakenly believe they have this incredibly robust escalation process, but in reality, all they have is a notification process, and there is a huge difference. In a notification process, information moves. Maybe an automated email gets sent to the chief risk officer, right? But the exact same person still makes the actual decisions. In a true escalation process, authority moves. A completely different person takes over the decision-making power. Listen, notification is definitely useful, but it absolutely will not stop a desk from continuing down a catastrophic path. Why? Because the stressed, exhausted individual who chose that bad path to begin with remains entirely in control. So you have to apply this acid test to your own desk. After your so-called escalation process runs, ask yourself, has the identity of the decide owner actually changed? If the answer is no, you don't have an escalation process. You just have a notification process, and your safety net is an illusion. Moving on to Section 2, triggers and delay costs. This brings us to the actual mechanics of triggering an escalation, which exposes the single biggest design flaw on modern trading desks. The most common and honestly most dangerous defect is relying on discretionary triggers. A discretionary trigger requires a human being to actively use their judgment to decide if an escalation is warranted. Like a rule saying, escalate if the position becomes concerning. Well, under stress, the trader inside that position is tired, they're heavily invested in their strategy, and they almost always view escalating as a personal admission of failure. Discretionary triggers systematically fail exactly when you need them the most. What you actually need are conditional triggers. These fire automatically based on hard, observable data feeds. Think things like post-trade utilization exceeding 90% or days to exit hitting 5. They fire automatically whether or not anyone feels like they should. And to put into perspective why conditional triggers are completely mandatory, just look at this number. Delay is never, ever free. In one real example, a U.S. desk was holding 320,000 MMBTU. Their escalation trigger required human judgment, and that caused a 40-minute delay. During just that 40-minute hesitation, the market moved 62 cents against their position. That hesitation literally cost them nearly $200,000. But wait, it gets worse. There is a compounding cost that's actually far more dangerous. During those 40 minutes, the trader, who still held the decide authority, actually added to the bad position. This is exactly why your trigger must move authority, not just information.
All right, Section 3, Governing System Overrides. Let's talk about deliberately departing from a system value. An override is a deliberate decision to depart from what your ETRM or control system is telling you. And look, gas desks require them. Models fail, and physical reality often diverges from what the system thinks is happening. The question is never whether to permit overrides, you have to. The question is how to ruthlessly govern them. There are 4 non-negotiable rules here. First, they can never be self-approved. The person benefiting from the override cannot be the one to authorize it. Second, they must always be logged with a free text reason, absolutely no generic drop-down menus. Third, they must always be time-bound. They literally have to expire. And fourth, override frequency must be a tracked metric. Now, I want to double down on that third rule. Making an override time-bound is the absolute most critical rule for your desk's survival. A permanent override isn't an override. It's just a system defect that you've decided to ignore.
Now into Section 4, EU versus US escalation mechanisms. We have to look at the dual-track reality of global gas trading because they fail in fundamentally different ways. Let's start with Europe, which typically fails on financial liquidity constraints. Here's a European worked example. Imagine a desk has a massive, perfectly correct hedge. They are 4 million megawatt hours short at 38 euros. But suddenly, the market price rises to 42 euros, and this triggers a massive margin call. The desk only has committed available liquidity of 120 million euros. In this scenario, available cash is the absolute binding constraint, not the theoretical P&L. So, we desperately need a conditional trigger that fires before the desk runs out of cash. A good rule of thumb is triggering an escalation when the margin call hits 50% of their committed liquidity. Half of 120 million is 60 million euros. We can just reverse engineer that 60 million into a hard market price. A 15 euro adverse move on a 4 million megawatt hour position equals exactly 60 million euros. Add that 15 euros to the 38 euro strike price, and boom, we get a hard conditional trigger at exactly 53 euros per megawatt hour. By doing this upfront, you create an automatic alert in the trading system that requires absolutely zero math and zero human judgment during a massive crisis. Pivoting over to the North American market, we face a completely different beast. Here, desks fail on hard, physical operational deadlines. Pipeline nomination cycles simply do not move. You literally cannot negotiate with physics or a pipeline operator's clock. Therefore, your escalation design over here must be time-boxed backwards from that unyielding physical deadline. Let's look at this standard US nomination timeline. At T-minus 90 minutes, the scheduler checks for confirmed supply. At T60, if there is a mismatch above 5%, the desk is notified. But watch what happens at T30. Authority formally moves to the desk head, and pay very close attention to this T10 row. If the desk head is unreachable for whatever reason, 10 minutes before the cutoff, a pre-authorized default executes. The scheduler acts under a standing delegation. I can't stress this enough. Most desks fatally lack this T10 row, and having it is the only thing that prevents a total operational freeze when things go wrong.
Section 5. Case Studies in Action. To really see why these mechanics matter so much, let's look at two composite case studies. These are drawn directly from real regulatory and audit patterns. First, our European composite case. A desk trading an illiquid hub introduced what was a perfectly legitimate price override. They needed to mark positions to broker-quoted levels because the ETRM system curve was totally stale, perfectly fine, right? But the override was approved monthly, then quarterly, and eventually it just became standard standing practice. In fact, it was applied 400 times over 2 years without a single review. Because this override lacked an expiry date, it suffered from what we call override drift. It slowly drifted from actual broker-quoted levels to optimistic, desk-estimated levels. Nobody maliciously decided to mark the book up. Natural drift just did it over time. But the result was a silent P&L bleed, creating a massive overstatement of almost 650,000 euros. This is exactly what happens when a temporary fix becomes a permanent, unreviewed process. Now contrast that with our U.S. composite case. This was an operational escalation that fired perfectly during a deepening winter deep freeze event. The desk held a supply obligation, and they had a conditional trigger set up to fire on a 5% mismatch inside the T60 window. At T58, based purely on a confirmed volume data feed, the trigger fired automatically. Authority instantly moved to the desk head. The desk head then elected to buy replacement supply at T42. Now, did it hurt? Yes, it cost them $224,000 above plan, but that automated trigger saved them from a catastrophic hit. The cold event worsened severely overnight and prices spiked to $96. Had they hesitated or waited for someone to make a judgment call, the loss would have been $3.2 million. Because they acted on hard data and not on feelings, they avoided a loss of nearly $2.9 million. Putting these two composite outcomes side by side really anchors the structural contrast here. On the left, you see a flawed discretionary system where a perfectly correct override decayed into a massive defect, simply because it wasn't time-bound, costing over €500,000. On the right, a robust conditional automation, where a trigger held firm because it was tied to data, avoiding a multi-million-dollar disaster. The ultimate takeaways here are simple. Time-bound everything, and design controls that fire on conditions, not on human feelings.
Finally, Section 6, Building Your Trigger Register. It's time for our hands-on applied build. I challenge you to sit down and audit your own desk survival systems using exactly the principles we just discussed. I want you to walk through this step-by-step exercise with your team to stress test your register. Step 1. List every single trigger on your desk. Step 2. Brutally classify them. Are they conditional or discretionary? Step 3. For every conditional trigger, identify the hard observable data feed it fires from. Let me be clear, if there is no data feed, it is just a discretionary trigger in disguise. Step 4. Verify that the decide owner actually changes. Otherwise, remember, it's just a notification. And Step 5. Backtest these triggers against the last 12 months of your position data. If a trigger never fires, it's miscalibrated. If it fires every single week, people are just going to ignore it. Which leads us to a pretty provocative final thought. We've established today that an override is fundamentally a decision about what your P&L number is going to say on any given day. But what does that final number actually mean in reality? How does that number decompose, and why is the unexplained component the one a desk head will absolutely always read first? Well, that is exactly what we are going to unpack next in Chapter 10, the senior view of gas desk P&L. Make sure to apply these override governance rules to your own desk today, and I'll see you in the next chapter.
Welcome back to the explainer for the Natural Gas Trading Desk Master Program. If you're new here, I'm your host, a consultant from Durga Analytics with a couple decades of experience running gas desks across European and North American markets. We are on a massive, sequenced journey together. We're talking 9 modules and 120 chapters covering the whole shebang. From market structure and the physical reality of pipelines, through risk and ETRM systems,
all the way up to desk leadership. Today, we are right in the thick of Module 1, specifically Chapter 10, the senior view of gas desk P&L. I'm going to take you behind the curtain and show you how a senior desk head actually reads a profit and loss statement. And trust me, it is vastly different from what a junior analyst sees.
Let's start with a hard truth right out of the gate. An aggregate top-line profit figure, it's basically an illusion. It answers almost no useful questions about a gas desk. Think about it. If two entirely different desks both report an identical $5.4 million profit, they could have run completely different businesses. They might have taken wildly different risks and faced completely different threats to their survival to get there. The number itself is not the point. The composition of that number, that is absolutely everything.
So here's our roadmap for today's diagnostic deep dive. We'll start with the aggregate P&L illusion, deconstruct the attribution engine, look at the clash between economics and cash in Europe, explore the hidden dangers of outperformance in the US, build the engine ourselves, and finish up with some fascinating case studies in control failure.
Okay, Section 1. Let's shatter this illusion of the aggregate P&L. When a senior leader looks at P&L attribution data, they actually read it from right to left. You might naturally be drawn to that big final closing mark, say a $5.4 million profit, but to a desk head, that number is far less important than the unexplained category sitting right next to it. That unexplained portion measures the gap between what your desk's pricing model said should have happened today and what actually did happen. It's a literal measure of how well the desk understands its own book. If that unexplained piece is persistently large, you don't have a math error. You have a major control finding on your hands.
To read that data accurately, we need the right toolkit. So, moving into Section 2, let's deconstruct this attribution engine into its core components. Every single daily move in your book gets bucketed here. It's like a forensics X-ray. Flat price tracks your directional exposure to the outright level of gas. Basis is where a basis desk actually earns its keep, tracking locational spreads. Curve shape? That tracks whether your seasonal storage positioning is actually working out. We also isolate time decay, FX exposures, and new trades. When you break your P&L down like this, you can see exactly what generated your returns, what risks you took to get them, and what remains an absolute total mystery.
Now here is the kicker. A persistently negative, unexplained component isn't just some quirky modeling error. It is honestly the most serious control finding a desk can have. Listen, if your unexplained P&L is small and random, that's just normal market noise. If it's large and random, well, your model is probably missing a risk factor. But if it is persistently negative month after month after month, it means value is physically leaking out of your desk somewhere the attribution just cannot see. We're talking hidden fees, deal capture errors, or serious operational leakage.
We also have to heavily scrutinize the new trades component, specifically what we call day one profit. So when a desk executes a trade at a price better than its own model's valuation, it recognizes an immediate profit. In a liquid market where your model is calibrated to real observable prices, sure, that day one profit captures genuine value. But in an illiquid market where there are no observable prices, your model is calibrated purely to your own internal assumptions. Recognizing day one profit there might literally just mean you are rewarding yourself for having a completely wrong model. All right, Section 3. Let's test this in the field and see how it behaves in reality, starting with the European market and the massive conflict between economics and cash.
Look at this real-world European hedged book. This is exactly what a board report looks like. The desk proudly reports 7.5 million euros in total profit to the board. Finance is happy. They see 2.1 million realized. Risk sees 5.4 million unrealized. Everyone's high-fiving, right? But hold on. Look down at the bottom. Look at the margin posted and the cash generated.
Yep, despite the $7.5 million in paper profit, this desk actually consumed 14.2 million euros in hard cash. This happens all the time with margined financial hedges placed against unmargined physical value.
Reporting profit without clearly showing the cash consumed to earn it is actively misleading to anyone responsible for funding the desk. Profit is great, for sure, but cash is what actually prevents insolvency.
Let's jump across the pond. Section 4, the U.S. market. Here, we're going to look at how a massively profitable month can actually be a profoundly bad month.
Check this out. In our U.S. worked example, the desk delivered nearly 3 times their profit plan. Sounds incredible. But when we decompose those numbers with our attribution engine, we find out that 100.7% of their total P&L actually came from unmandated directional flat price exposure. Basically, they took massive directional risk that they were absolutely not supposed to be taking, and they just got incredibly lucky.
To make matters worse, their actual mandated basis strategy, the very thing they were hired to do, underperformed by 56%. Celebrating this top-line outperformance rewards totally uncontrolled risk. A desk head who celebrates this teaches the team a very dangerous lesson, that blowing past your mandate and gambling on flat price direction is the best way to get your bonus. The correct management action here? Recognize the P&L, sweep the unintended risk immediately, and assess the traders strictly on their failing mandated strategy.
So, how do we systematically catch these issues before they blow up our desks? Section 5, we roll up our sleeves and build the attribution engine ourselves. This is a crucial practical build for any aspiring risk manager or quant.
Here is how you build it. You take your inputs, positions, curves, trades, and you revalue the opening book sequentially. You move one factor at a time while holding everything else constant. Now actually, scratch that. Make sure you really internalize this next part. Order matters immensely here because of cross-terms. So whatever ordering convention you pick, document it and never change it. Otherwise, overlapping market moves will completely distort your data. Unexplained becomes your mathematical plug at the very end. And most critically, you must track that unexplained plug as a time series and run a binomial sign test over 12 months. Why? Because that test tells you definitively if your errors are just random market noise or a hidden systematic leak bleeding your desk dry.
Let's bring this all home in Section 6 with some case studies in control failure. Now, these are composite autopsies drawn from industry patterns, not specific firms, but they show exactly what happens when desks fail to implement these controls. In our European composite case, a desk leaked 4.32 million euros over 2 years. Why did no one notice? Well, because their monthly unexplained variance was always within their small acceptable tolerance limits, but nobody noticed that the residual was negative 11 out of 12 months. Statistically speaking, a negative residual occurring 11 out of 12 months only has a 0.6% probability of happening purely by chance. The sign pattern itself was screaming that there was a systematic defect. In this case, unmodeled fee accruals and capture timing errors. But because management only monitored the magnitude of the error and not the sign pattern, they were completely blind to it.
This brilliantly illustrates the contrast between how these markets fail. Europe failed by monitoring tolerance levels instead of sign patterns. Meanwhile, our U.S. composite case failed differently. They originated structured deals at highly illiquid regional points and booked a massive $5.65 million in day-one profit over 18 months, based purely on their own internal model. Well, when a cold event repriced the basis, they suddenly realized their internal model was completely wrong and that profit never actually existed. The fix is simple. In illiquid markets, you absolutely must defer day one profit and release it over the life of the trade as real observable data confirms it.
So, what does this all mean for us? Well, everything we've analyzed today relies entirely on perfect deal capture, which brings us to a rather terrifying truth. A brilliant P&L attribution model is absolutely useless if the raw data feeding it is flawed. So how do you prevent bad data from destroying your desk? That leads us directly into Chapter 11. We're going to transform your ETRM system from mere trade entry software into a survival-grade control system. I'll see you there. Welcome to this explainer for Chapter 11 of the Natural Gas Trading Desk Master Program.
I'm joining you as a consultant from Durga Analytics, drawing on decades of experience building and running trading desks across European and North American markets. Just as a quick reminder, this entire program is a sequenced journey across 9 modules and 120 chapters. We go from what a gas desk is actually accountable for in Module 1 through market structure, playbooks, valuation and curves, risk, execution, ETRMs, regulation, and all the way to desk leadership in Module 9. Today we're wrapping up Module 1, focused on running a desk, and we're going to fundamentally shift how you view your ETRM, your energy trading and risk management system. You really have to stop seeing it as just a big database where trades live and start understanding it as a vital active control system for gas.
So here is our agenda for this diagnostic journey. We'll look at the ETRM as a control stack, the compounding cost of capture lag, taming your shadow systems, when generic systems fail gas, compare EU versus US ETRM failures, and finally, build out your system assessment.
I want to kick things off with this quote because it really nails our core philosophy for this explainer. Traders often just see the ETRM as a glorified typewriter for deals, but from a desk head's perspective, a position is completely invisible to your organization until it is captured in that system. That makes your ETRM the ultimate critical boundary between your firm's actual market exposure and its awareness of that exposure. Let's move into Section 1. ETRM as a control stack, the boundary between exposure and awareness.
To truly understand this boundary, we've got to throw out the software vendor pitch of isolated modules and look at the strict reality of control layers. Think of this as the propagation principle. Data flows downhill. Your stack starts at layer 1 with deal capture, flowing down into position keeping, valuation, risk computation, scheduling, and finally settlement. Because every single layer consumes the output of the one directly above it, a defect at layer 1, deal capture, inevitably poisons your position, your valuation, your risk, your scheduling, and your settlement. Honestly, desks that spend millions on fancy risk analytics but have sloppy trade capture, they're basically just decorating a house with a broken foundation.
Section 2. The compounding cost of capture lag, the blind spot.
Let's put some hard math on what happens when you have a delay at that very first layer of deal capture, which we call capture lag. Let's say a desk executes 850 trades a day and averages a 47-minute capture lag on a typical book of 2.1 million MMBTU. Just the direct revaluation error from those stale limits will instantly cost you $23,100 a month. But here is the terrifying part. That $23,000 is actually the smallest consequence of the lag. The real cost compounds. Every automated control built on your position data simply inherits that delay. So if your desk has built these excellent, highly sensitive conditional escalation triggers, but you suffer from a 47-minute capture lag, well, you just have excellent triggers that fire 47 minutes late on your absolute most volatile trading days. It is a massive blind spot exactly when you can least afford it.
Section 3. Taming your shadow systems, the cost of the spreadsheets.
Look, because of these system gaps and lags, every single gas desk inevitably builds shadow spreadsheets to do the work the ETRM cannot. It's not a moral failing, it's just a rational survival response by your traders. But let's audit what those shadow systems actually cost. Let's say you have just 34 material spreadsheets on the desk, and each one takes maybe half a day of manual monthly reconciliation to match the system of record. Do the math. That bleeds 204 full-time equivalent days a year. You are wasting nearly an entire headcount just proving that your multi-million-dollar ETRM matches a trader's Excel sheet. So how do we handle this constructively? First rule, do not ban them. If you ban shadow systems, that activity just moves somewhere darker and less visible. Instead, inventory them. Write down exactly what they compute and who maintains them. Then, rank them by materiality. Which ones are actually feeding your reported numbers? Fix those specific ETRM gaps first. Ultimately,
Treat your shadow system inventory count as a core system quality metric. If that spreadsheet count is going up, your ETRM is drifting further away from what your desk actually needs to trade.
Section 4. When generic systems fail. Gas, volumes, capacity, and location. This brings us to why generic, off-the-shelf commodity systems struggle so badly with the actual physics of natural gas. They usually fail at native multi-unit positions, they fail at treating pipeline capacity as a distinct asset, and they handle locational granularity terribly. Take a look at this table for a typical U.S. gas operation. You have 3 totally distinct volume figures for one transaction. You nominated 26,000 MMBTU, that's what you asked for. The pipeline confirmed 24,500, and what actually flowed, the scheduled volume, was 23,880. If your ETRM only gives you one generic volume field, it can't compute that 1,500 MMBTU variance between nominated and confirmed. It conflates a critical pipeline constraint with a simple measurement error. And that leaves your U.S. desk completely blind to capacity availability signals, signals that actually have massive trading value. Section 5. EU versus U.S. ETRM failures. How the markets bleed differently.
To master this craft, we have to contrast how systems fail structurally in Europe versus North America, because they break in completely different ways. Let's look at our European composite case study. A desk expands from the Dutch TTF into the UK NBP market. NBP trades in pence per therm, but their generic ETRM only natively holds 1 unit per commodity, megawatt hours. So the system irreversibly converts the therms on entry using a statically rounded factor. The arithmetic here is absolutely brutal. Because of that rounded factor, on every 480,000 therms traded, it creates a 3.4 megawatt hour discrepancy. This isn't just random noise that cancels out over time. It's a systematic bias. It causes a persistent, mathematical bleed that requires nonstop manual reconciliation with broker statements, generating unexplained negative P&L residuals for years.
Now flip over to our North American composite case. Here, a U.S. desk holds physical salt dome storage, but their generic ETRM models this physical position simply as a summer-winter financial spread, totally ignoring the actual physical inventory state. The risk system knows the spread's value, sure, but it has no idea how full that cavern actually is. Suddenly, December hits. It gets incredibly cold. Inventory draws down fast, and deliverability plummets. The ETRM blindly reports a fully hedged, safe position because the financial spread hasn't moved. It's operations that discovers the massive physical shortfall, not risk. Because the desk had to rush to the spot market to cover 490,000 MMBTU of undeliverable hedged volume at $22.40 during a spike, the net cover cost was a catastrophic $8.7 million.
When you put these 2 composite cases side by side, you see 2 totally distinct survival threats. European desks bleed slowly through layer 1 and 2 systematic conversion errors. It's annoying, it's persistent, and it drains resources. But U.S. asset-backed desks experience catastrophic layer 3 and 4 blowouts because their risk models cannot see the physical realities of pipelines and storage. Modeling storage as a simple spread is fine if you're purely trading financials, but if you're an asset-backed desk, it is deeply, deeply dangerous.
Section 6. Build your system assessment, desk-ready homework.
All right, it's time to turn this consulting audit over to you so you can execute it on your own desk tomorrow morning. Here is your applied adequacy build. First, assess your system's obligation rung against the framework we covered back in Chapter 2. Second, do that spreadsheet inventory. Third, measure your capture lag as a distribution, and I want you to focus specifically on the tail end during your most volatile days, because that is exactly when a blind spot will wipe out your P&L. Finally, compute your exact revaluation bleed in actual dollars and cents. These tests matter because they prove whether your system is actually protecting the firm's capital or just giving you the illusion of control.
I'm going to leave you with this provocative test of your foundation. Pick one single reported number off your desk today.
If you cannot complete a full traceback through every layer of the stack to its absolute raw source in under an hour, your ETRM is failing as a control system. It's a stark realization for sure, but it's an essential one. And that leads us perfectly into our final chapter of Module 1, Chapter 12, where we'll analyze the hard lessons from failed gas desks. Keep learning, keep analyzing, and I'll see you in the next explainer.
Welcome back to The Explainer. I'm your desk-side mentor from Durga Analytics. Having spent a few decades trading physical and financial gas across both European and North American markets, building desks and designing ETRM systems, I am absolutely thrilled to dive into Chapter 12 with you. Today, we're covering lessons from failed gas desks and officially closing out Module 1. So, whether you're an aspiring gas trader, an originator, a quant, a risk manager, a scheduler, or deep in the ETRM weeds, this chapter is built exactly for you. Real quick, just to anchor us in the wider Natural Gas Trading Desk Master Program, we are on a perfectly sequenced journey across 9 modules and 120 chapters. We started right here with governance, and as we push forward, we're going to tackle market structure, playbooks, valuation, risk, execution, ETRM systems, regulation, and all the way through to desk legacy. And remember, every single module is built around real markets, real numbers, and verified arithmetic. Today, we synthesize everything we've learned in Module 1 into 4 key areas: the endogenous decay of trading desks, a tale of 2 desks comparing the US and Europe, the brutal arithmetic of failure, and finally, your desk durability checklist. Let's kick things off with Section 1, Endogenous Decay of Trading Desks. We are pivoting from what a gas desk is supposed to do to why they actually fall apart in the real world. Every desk goes through a life cycle: build, peak, drift, and ultimately decay. What is absolutely crucial to understand here is that this decay is endogenous. Desks rarely blow up just because the external markets get harder. They rot from within. See, markets change constantly, but control frameworks, they only change discreetly when someone actively decides to update them. The people who actually understood why a specific control was built eventually leave the firm. Their successors inherit the control without understanding the original why. So as the market evolves, traders start using workarounds to get things done, and these perfectly rational little workarounds aggregate until the control framework no longer describes the actual business at all. To be radically candid with you, across the 11 case studies we've reviewed in this module, 6 European and 5 American, the root cause of failure is incredibly consistent, and it is literally never ever just that the traders were bad at trading. Failure is almost always about structural defects. We're talking about hedging the wrong risk because a certain instrument was chosen just because it was available rather than matching the actual exposure. Or maybe they're sizing positions to their conviction instead of sizing to the exit, assuming liquidity is just a constant. Or they're operating with messy, ambiguous decision authority. The defect is there, it's totally detectable, and here is the scary part. It is highly profitable for months, sometimes years. Desks fail because the defect gets rewarded right up until the day it suddenly doesn't. On the flip side, how do durable desks survive? They build ironclad habits. They monitor patterns instead of just looking at levels, meaning they track the frequency of system overrides instead of just waiting to hit a P&L limit. They record their near misses. If an intervention stops a total disaster, somebody writes it down so the desk actually learns from it, completely cutting out survivorship bias. And most importantly, they separate the assessment from the outcome. You can have a month where you make 3 times your budget, but if you took risk wildly outside your mandate to get there, that is assessed as a terrible month. Moving right along to Section 2, 2 desks, US versus Europe. We always cover both regions because they are structurally totally distinct, and frankly, they tend to fail in very different ways. Let's contrast 2 constructed composite case studies. We've got a durable European desk and a US desk suffering from that slow endogenous decay we just talked about. The European desk was relentless. They enforced a strict 30-day expiry on any system overrides, and they maintained a prevention register that actually logged 94 near misses over 6 years. The US desk? Well, they started strong, but the architects of their control framework left in years 8 and 9. As the U.S. market evolved with totally new pipeline capacity, those inherited controls were never recalibrated. Shadow systems exploded from 6 to 29, and manual overrides spiked from 4 a month to 31 a month. Total structural drift. Fast forward to year 13 for that U.S. desk, and boom. An $18.4 million loss triggered by a moderate basis event that their risk system essentially deemed implausible. That loss represented 5.9 times their value at risk. This is exactly what happens when a model calibrated to a vanished market finally snaps. It doesn't fail by a small margin, it fails by a massive multiple. Both the override count and the shadow system count were screaming that the framework was decaying, but guess what? Neither of those metrics shows up on a standard P&L report.
Now, look at the European desk during a massive market dislocation. They hit a conditional liquidity trigger. Not a market price view, mind you, a pure liquidity metric. The desk had the explicit authority to act instantly, and they paid 1.36 million euros in spread costs to chop their gross exposure in half. Shortly after, the market suffered an absolute meltdown. By paying that 1.36 million euro cost up front, they completely sidestepped a 73.6 million euro loss. That is a staggering 54x return on the cost of prevention. And because they actually utilized a prevention register, that 1.36 million was correctly logged as a brilliant preventative move rather than just a trading loss. Music to a risk manager's ears, right? Which brings us nicely to Section 3, the arithmetic of failure. How do we actually quantify the cost of ignoring these structural issues across the broader industry? If you exclude the massive sector-wide black swan events like Winter Storm Uri, the routine case studies we've examined in Module 1 still account for $107 million in combined losses. And here is the absolute kicker for anyone out there designing ETRM systems or running a risk function. Every single one of those losses could have been caught by a detector that was either completely free, easily automatable, or took maybe 3 days to build. From simply enumerating the mandate properly to implementing a daily residual sweep, the fixes are right there. They're incredibly accessible. Let this sink in for a second. Detection is cheap. Failure is expensive. The ratio isn't even close. Yet, if you walk onto trading desks around the world, you'll find that these early warning detectors are consistently unfunded. Why is that? Because the cost of building the detector is highly visible in today's budget, while the massive benefit of a multi-million-dollar disaster avoided is completely invisible on a standard P&L statement. A desk head's truly durable legacy isn't usually some spectacular hero trade. It's building the reporting architecture that lets the firm actually see what didn't happen.
Finally, Section 4, the durability checklist. This is your applied build for the chapter, a highly practical toolkit to assess your own trading floors before taking on massive market obligations.
If you run or support a gas desk, you need to ask these fundamental questions today. Does every single decision row in your matrix have exactly one decide owner, totally eliminating ambiguity? Are your near misses recorded in a formal prevention register right alongside actual losses? Is unexplained P&L tracked as a time series and tested for its sign, meaning is it consistently bleeding negative, rather than just being ignored because the dollar amount seems small? A desk that can honestly answer yes to all 10 items on our checklist is incredibly rare. But knowing exactly which ones you fail is the first critical step to survival. I want you to ask this exact question of your own desk right now. If a compliance officer looked solely at your written mandate today, could they definitively determine if yesterday's trades were permitted without having to pull a trader aside to ask for context? When you read about some massive desk failure in the news, don't just ask what they did wrong. Ask which of our 10 checklist questions they would have failed, and then aggressively apply that same scrutiny to your own operations.
Converting historical anecdotes into strict operational ETRM controls is the single most valuable habit you can take away from this entire module. So I'll leave you with this somewhat provocative thought. Are your current profits simply rewarding a hidden defect that is just sitting there waiting for the market to shift? Think about it. You now have the complete governance frame for a gas desk locked in, but governance has to operate in physical reality. So, in our next chapter, we kick off Module 2, diving headfirst into the actual physical structure, the pipelines, and the storage physics of the North American and European gas markets. I can't wait to see you there.